Welcome back to Wall Street Podcast. Today, we're taking a deep dive into the electrifying world of China's new energy vehicle market.
That's right. Things are moving fast over there.
Absolutely. Our focus is a fresh report from Goldman Sachs China Securities, their China New Energy Vehicle Weekly Chart Book, which actually just came out yesterday, July 2nd, 2025.
Hot off the press.
Exactly. And this one covers week 26 of 2025, so that's June 23rd to June 29th. Our mission, like always, is to cut through that data, pull out the really critical insights, and figure out what these numbers mean for you, our listeners.
Precisely. And this chart book, it's more than just numbers. It's a really dynamic snapshot. You get everything from overall market penetration, brand performance,
Yay.
down to pricing shifts, incentives, even upstream stuff like battery dynamics. It really lets us connect the dots on what's driving the NEV scene in China right now.
And it shifts so quickly.
That's the compelling part. This report gives you that granular detail to see those pivots almost as they happen.
Okay, let's kick things off then. The macro picture first. What were the headline trends for vehicle registrations in week 26?
Well, looking broadly, there was a pretty solid uptick. Passenger vehicle weekly insurance registrations, they hit 570,000 units.
Okay.
That's up about 4% week over week. But the real story, the standout, was new energy
Oh,
vehicles,
the whole.
NEVs.
Right.
They saw an even stronger jump, 296,000 units. That's up 5% week over week.
5%. So that leads to the big number, right? The penetration rate.
Exactly. This is where it gets really interesting. NEV penetration hit 51.9%.
Wow. Up from 51.6 the week before.
Just a 0.3 percentage point increase, but crossing that 50% mark.
Over half. Over half of all new vehicles registered were NEVs. What does that actually signify, hitting that milestone?
I mean, it's huge. It's more than just a number.
Yeah.
It's a psychological tipping point and a practical one, too.
How so?
Well, it suggests NEVs aren't niche anymore, not even just an alternative. They've firmly hit the mainstream.
The default choice, almost.
For a majority of new buyers last week, yes. And that has massive implications for, traditional automakers still focused on IC.
Internal combustion engines, yeah.
Their market share is clearly shrinking fast unless they pivot aggressively. And for the NEV specialists, it confirms their position, but also ramps up pressure on infrastructure charging, batteries, everything.
Right. Scaling becomes key.
Absolutely. For investors, it suggests the market's hit critical mass. Growth now comes from taking that ICE share and catering to a broader maturing base.
Okay, let's shift gears then. Zoom in on the brands. The report highlighted some pretty strong individual performances. Who really stood out in week 26? Growth, volume?
Yeah, if you look at the brand summary, the growth figures are, well, eye-opening. Xiaomi, relatively new, led the pack. 97% week-over-week growth.
97%. That's incredible.
It is. From a smaller base, sure, but still. Then you had Firefly at 74%, Luxeed at 56%, really strong jumps.
And in terms of just sheer volume, the big players.
Oh yeah, the giants held their ground there. BYD, Tesla China, and AITO were the top three. Market shares were roughly 27% for BYD, 7% for Tesla, and 4% for AITO.
Okay, so BYD still way out in front on volume. But what about market share shifts week over week? Any significant gains or losses?
Definitely some movement there. Tesla China actually saw the biggest gain, up 2.1 percentage points.
Okay.
Followed by Xiaomi, up 1.4 points, and XPeng, up 0.8 points.
Interesting. And on the other side, who lost share?
BYD saw the biggest drop, actually, down 2.9 percentage points week on week.
Despite leading in volume.
Exactly. And Li Auto was down about half a point, Deepal down just 0.1 points. It really highlights the dynamic nature of the competition.
Yeah, absolutely. So what about new orders? That gives us a glimpse into the pipeline, right?
Critical point, that forward look. In week 26, Xiaomi, riding that growth wave, pulled in a massive 280,000 new orders.
280,000 for Xiaomi.
Yep, huge number for a relative newcomer. Then Hema got about 11,000 orders, Leapmotor around 10,000.
So what does that tell us? Especially with Xiaomi making such a splash.
Well, it underscores how crucial a fresh, appealing model and a really effective market entry are in China right now.
Brand matters, but product matters more, maybe?
Or at least a new compelling product matters a lot. BYD is still the undisputed volume leader, no question. But these shifts, especially the order numbers, show intense competition. Consumers are absolutely willing to explore new brands if the offering's right. It keeps everyone on their toes.
Okay, let's pivot to pricing. Always a hot topic in this market. The report mentioned official MSRP cuts, manufacturers' suggested retail price. What did we see in week 26?
We saw 3 official cuts on NEV models that week, still seeing that competitive pressure play out.
Okay, who made the move?
Let's see. SAIC Rising Auto launched facelifts for their R7 and F7 models. The R7 got an average cut of about 15,000 RMB, so roughly 7%. The F7 got a bigger cut, 30,000 RMB, which is like 13% down.
Significant cuts.
And then Great Wall launched a facelift for the Aura Good Cat. That saw an average cut of 27,000 RMB. That's a hefty 22% reduction.
Wow, 22%. How does this compare to sort of the overall trend of price cuts this year?
Good question. Provides context. So year to date, the report logged 55 official price cuts across the market, averaging about 8% down.
Okay.
Now compare that to the same period in 2024. There were actually more cuts then, 75 of them, but the average reduction was also 8%.
So fewer cuts this year so far, but the average depth is the same. Still aggressive.
Exactly. The intensity hasn't really let up. Now, beyond those official MSRP changes, what about dealer discounts? How are NEVs looking versus IC cars on the forecourt?
Right, the actual transaction price.
This is where you really see the pressure. As of June 30th, the average NEV dealer discount versus MSRP was 8.11%. That actually narrowed just a tiny bit from 8.15 the week before.
Okay, slight easing maybe.
Very slight. BYD's average discount also narrowed fractionally to 5.49%. But compare that to IC vehicles.
Yeah.
Their average discount was staggering, 22.87%.
23% off sticker on average.
Almost. And that only narrowed slightly from 22.95. So yeah, continued price competition for NEVs. But ICE cars are facing much steeper discounts to move inventory.
Tells the story right there. And what about government support, the auto trade-in subsidy program? How's that playing out?
Oh, it's definitely gaining steam. As of the end of May, the official platform had received 4.1 million applications for that subsidy.
4 million.
And the key thing is the acceleration. In the latter half of May, average daily new applications jumped to 45,000. Up from 32,000 in the earlier part of the month.
So a significant jump.
Absolutely. It clearly shows the program is working, gaining traction, and giving the market a real boost by encouraging people to upgrade. It's a strong demand lever.
Good to see. Okay, let's look upstream for a moment. Supply chain. Battery pricing, what are the dynamics there?
Well, on the cell level, prices were actually stable week over week. LFP prismatic cells flat at RMB 0.31 per watt hour. NCM prismatic cells also flat at RMB 0.42 per watt hour.
Okay, stability there. What about raw materials like lithium?
There we saw a slight move. Battery-grade lithium carbonate prices actually increased 2.8% week over week, up to about RMB 61,400 per ton.
An increase after all those drops.
Exactly. And this is a critical context. Despite that little weekly bump, it's still way down compared to previous quarters.
How far down?
Let's see. It's down 43% versus the Q2 2024 average, down 24% versus Q3 24, 20% versus Q4 24, and 19% versus Q1 of this year, 2025.
Okay, so a tiny blip up and a massive downward trend overall. What's the implication of that for manufacturers?
Well, that sustained lower cost for lithium, even with this small rise, is still a huge relief. It gives them a crucial buffer. They can either pocket that as margin or pass it on.
Which we've seen them do.
Right. Fuels the price competition. So what key events should we be watching for right now in the immediate future?
Yeah, what's coming up?
Okay, so this current week, week 27, we've got the XPeng G7 officially launching tomorrow, July 3rd, and the BYD Seal 06 DMI Touring version launches July 4th.
Okay, more new models hitting the market.
Always. And then looking a bit further into July, around the 10th or 11th, the CPCA, that's the China Passenger Car Association, will release the full June industry data. Wholesale, retail, the whole picture.
That'll be important, Dave.
Definitely. And also expected sometime in July are the official launches for the Li Auto i8 and the NIO Onvo L90.
So the pipeline is just relentless, keeps the pressure on.
Absolutely. Constant stream of new models. It's a defining feature of this market.
Okay, now for some deeper insights for you, our listener. Let's dig into a few key questions that arise from all this. First one, NEV penetration just crossed 50%, but we're still seeing these deep price cuts. Is this market getting close to saturation, or is there still, substantial growth potential left?
That's a great question. And no, I'd say 51.9% penetration, while it's a huge milestone, it definitely doesn't signal saturation for the entire auto market.
Right, it's NEV penetration, not total car saturation.
Exactly. What it signals is NEVs becoming the mainstream choice among new car buyers. But the overall Chinese auto market is enormous. There's still a massive pool of older ICE vehicles on the road.
So growth comes from converting those ICE owners.
Primarily, yes. And also expanding into lower-tier cities and demographics where NEV adoption might be lagging slightly. The price cuts, while tough on margins, actually help accelerate that by making NEVs more accessible.
So the cuts fuel further growth in a way.
They do. And the strong weekly registration growth, those huge order numbers for brands like Xiaomi, it all points to significant runway left. Investors should watch battery costs, charging infrastructure expansion, and how legacy automakers adapt.
Okay, second question. Tesla gained share last week. BYD lost a bit, even though BYD is dominant overall. What does that dynamic tell us about maybe the competitive strategies and what consumers are looking for?
Yeah, that push and pull is fascinating. It really shows how fierce and nuanced the competition is. Tesla's gain could be down to specific models doing well, maybe a pricing tweak hitting a sweet spot, maybe just timing.
Right.
BYD losing a bit of share in one wink, while still being the volume king, suggests maybe a strategic choice. Perhaps focusing on profitability in some segments rather than chasing every last point of share every single week.
Managing the scale.
Could be. They have such a broad portfolio. The key takeaway is it's not zero-sum. Different brands can succeed by targeting different niches, different value propositions. Consumers have tons of choice, and they're clearly willing to explore. It's very sophisticated.
Final question then. Battery raw materials like lithium down massively year over year, but saw that tiny bump week over week. How does that fluctuating cost impact profitability versus pricing strategies going forward? Is it margin relief or just more fuel for price wars?
It's really the central tension, isn't it? That slight weekly increase in lithium is probably noise, maybe a small market correction or demand pull. The dominant trend is that huge year-over-year decrease.
Right, that's the bigger picture.
And that sustained lower cost is a massive strategic lever for manufacturers.
Yeah.
Do they use it to repair margins that have been battered by price wars? Or do they pass those savings on, double down on aggressive pricing to grab even more market share, especially from ICE cars?
Given the competition.
Exactly. Given the intensity, I think we'll continue to see a mix, but probably leaning heavily towards competitive pricing. Capturing volume and market leadership, especially as NEVs become the default, seems to be the priority for many. It's a tough balancing act between short-term profits and long-term dominance.
Okay, so wrapping this up, what does it all mean for you? Well, the China NEV market in week 26 just kept up its incredible pace. We're seeing sustained high penetration over half. Intense competition between the giants and the newcomers.
Yeah, really fierce.
And this persistent focus on price, with official cuts, dealer discounts, all boosted by those government trade-in subsidies. It really is a market that rewards being agile, innovative, and strategically sharp.
Absolutely. The data makes it clear.
Yeah.
This isn't just market expansion. It's a fundamental reshaping of consumer views, industry strategy, and frankly, global auto competition, which leads to, I think, an important question for you to chew on.
Go on.
As this market matures further, gets even more competitive, beyond just price and range, what new strategies, what new levers will manufacturers need to pull to really stand out, maintain some profitability, but still fight for that market share?
Beyond price and range, that is a great thought. Something to definitely keep an eye on. That's all the time we have for this deep dive. Thank you for tuning in to Wall Street Podcast. We'll be back soon with more critical insights from the world of finance.